Welcome to this explainer. Okay, so have you ever tried to look at the sustainability profile or maybe the risk exposure of a commercial bank, only to feel like those raw numbers were totally hiding the real story? Yeah, it's a common problem. But today, we're unlocking a really critical tool. We are talking about normalizing data using activity metrics. If you've ever felt like raw data points just kind of leave you hanging without the full picture, well, you're definitely in the right place. We're going to break down exactly how the SASB standards give us the exact framework we need to cut through all that noise. Just think about this for a second. How do you actually fairly compare a massive global megabank operating in, say, 50 different countries to a small regional lender that only serves a single state? I mean, if you just look at the raw data, like the sheer number of data breaches or the total dollar amount of community development loans, the megabank is always going to have way bigger numbers, right? But does that mean their risk is actually higher? Or is their positive impact actually that much more significant? Look, relying on raw sustainability data without adjusting for those massive size differences is a huge trap. It literally leads to flawed analysis every single time. So here's how we're going to break this all down today. 1, the data comparison problem. 2, defining activity metrics. 3, tracking, checking, and savings. 4, segmenting the loan portfolio. And finally, 5, why normalizing this data actually matters. Let's jump right into section 1, the data comparison problem. Take a look at the stark divide between how we often get data versus how we actually need to use it. On the left side here, we've got this chaotic pile of raw sustainability data. Stuff like total financed emissions or the raw number of financial literacy participants. But on its own, it totally lacks scale and context. It's really just a raw floating number. But then look on the right, here we have normalized data. And this right here is what actually allows for a true apples-to-apples comparison. To get from the left side over to the right side, we absolutely must have an essential denominator to quantify the bank's true operational footprint, because without that denominator, your analysis is basically built on quicksand. Which brings us to section 2, defining activity metrics. Now, the official SASB standard gives us this really elegant definition. It says activity metrics are, and I'm quoting here, metrics which quantify the scale of specific activities or operations by an entity and are intended for use in conjunction with other metrics to normalize data and facilitate comparison, end quote. Okay, so the crucial part is right there in the text. These metrics aren't necessarily indicators of good or bad performance all on their own. Instead, they're the vital tools, the specific measurements of scale that actually allow us to normalize data. Basically, they're the missing piece of the puzzle we've been looking for. If we look at Table 2 straight from the SASB standard for commercial banks, we can actually see the 2 core activity metrics that banks are required to report. First up is FNCB-000.A, which deals with checking and savings accounts. And then right below that is FNCB-000.B, which focuses on loans. Together, these 2 specific metrics form the absolute foundation of our analytical toolkit here. Let's zoom in a bit. Section 3, tracking, checking, and savings. So under that first metric, FNCB-000.A, the standard requires banks to track 2 very specific, critical elements of scale when it comes to checking and savings accounts. First, the total number of accounts. And second, the actual financial value of those accounts, presented in the reporting currency. Now, why do we need both? Well, think about it. Just knowing a bank has, say, 1 million accounts doesn't really tell us enough, does it? We need to know, are these accounts sitting there with $10 in them or 10 million bucks? Tracking both the sheer volume of accounts and their actual financial value gives us a much truer, multidimensional picture of a bank's real scale. But honestly, the SASB standard doesn't just stop at those total numbers, because granularity is just as important as scale. The metric actually dictates that these figures, both the number and the value, have to be broken down into 2 distinct segments: personal accounts and small business accounts. And this makes total sense. A bank that's heavily weighted toward personal retail checking is going to have a completely different operational footprint and risk profile compared to a bank that mostly serves small businesses. By segmenting the data like this, analysts can normalize performance metrics specifically against the most relevant customer base. It's a real game changer. Moving right along to Section 4, segmenting the loan portfolio. So just like with deposits, lending is essentially the lifeblood of any commercial bank. That second metric we saw, FNCB000.B, tracks both the number and the value of loans, but it breaks them down across three very specific tiers: personal, small business, and corporate. This is just a brilliant structural requirement because it builds this really comprehensive, highly segmented view of the bank's entire lending footprint. I mean, if you're analyzing how a bank incorporates environmental, social, and governance factors into their corporate credit analysis, you absolutely need the exact scale of their corporate lending specifically to put that effort into context. Now, a quick heads up here, because there is a massive gotcha detail tucked away in the SASB standard that you definitely need to know. Note 6 explicitly states that mortgage loans as well as revolving credit loans are excluded from the scope of this disclosure. Understanding exclusions like this is absolutely vital. If you accidentally throw mortgages into your denominator while you're trying to normalize a specific commercial lending metric, your final calculation is going to be completely distorted. So definitely watch out for that.
All right, let's wrap this up with Section 5, why normalizing data matters.
Everything we've talked about really comes together in this one conceptual equation. When you have your raw metric data, again, things like the number of data breaches or total financed emissions, that serves as your numerator. But on its own, it's completely out of context. But then, when you grab the activity metrics we just explored, the exact number and value of those segmented accounts or loans, you finally have your denominator. That's your true scale of operations. And when you combine them, dividing that numerator by your denominator, the result is honestly kind of magical. You get normalized, comparable data. Suddenly, you can accurately and fairly compare the efficiency and risk management of a small regional bank in Ohio directly against a massive multinational bank in London. And really, that is the true power of activity metrics. They are the great equalizer in financial and sustainability analysis. So I want to leave you with this question to ponder. How will using these precise, normalized activity metrics change the way you evaluate risks and opportunities across different commercial banks moving forward? Because now that you finally have the denominator, the entire landscape changes. Thanks so much for joining me on this explainer, and keep exploring.